pleasure to host today's session, Capital with Purpose, Mobilizing Finance for Inclusive and Sustainable Growth. So we're here to explore something fundamental. Capital has never been more abundant, yet too little of it seems to reach the people and the places that need it most. As billions move through ESG portfolios and sustainability funds, perhaps the real question isn't how much we mobilize, but how well we use it. Today's conversation asks that, asks how finance can move beyond disclosure and compliance to truly serve people, planet, and long-term prosperity. In short, how do we make capital purposeful? I'm absolutely thrilled to be joined by three fantastic panelists, each offering a unique lens on how finance can drive real-world impact. Introducing Christine Angelova, Sustainable Finance Advisor and Singapore Ambassador for Investors for Climate, as well as a former Asia Sustainable Finance Lead for the World Wildlife Fund. Next up, Lily Thompson, Senior Researcher Associate at Jesus College, University of Cambridge, and Departmental Fellow for Finance for Systemic Change. And last, but by no means least, Go Mackay, Global Head of Impact at the Ide Strong Foundation and former Senior Operations Officer at the World Bank. Christina, Lily, Go-san, absolute pleasure to have you here. Together, our panel brings experience across policy, development finance, and systems changed, all focused on one essential question. How can capital become a genuine instrument of sustainable development? So, to kick things off, I'd love to begin with a simple but powerful question for each of you guys. What does capital with purpose mean to you personally, in the context of your own work? Christina, if we could begin with you.
Sure, thank you, John, and thank you for having me. So purpose, capital with purpose, I think for me means really investing in long-term capabilities and shared values. And I'll circle back to expand and elaborate a little bit on that, but I will never forget many years ago on my first day in finance class, when something stuck with me because our professor said, if there's one key takeaway that you take for your future career from this course, is that the sole objective and responsibility of people in finance and generally senior management is to maximize shareholder and investor value. So at the time, I really, that didn't resonate. And I think the view of the financial system, the way that it's built right now, for me is linked to extraction, efficiency, and optimization. And I think that elephant in the room that I think a lot of us in the sustainable finance space struggle with, which is short-termism, right? The chasing short-term returns. And that really aligns with that whole kind of system or that capitalist way that the financial system is built in, assuming a zero-sum world where obviously gains for one side require sacrifices on the other side. And again, that doesn't resonate. And I think we can see that by design, this is flawed. So as you say, we don't need more capital in the world, but we need capital designed with intention. So again, for me, capital with purpose really values nature and livelihoods as fundamental economic assets beyond just externalities, and hence aligns flows with that long-term development and environmental ambition. So also allowing, of course, countries to mobilize finance without trading their futures away.
Super. Thanks, Christina. To be continued. Lily, over to you, if I may.
Sure. I would say it's really about responsibility. Investors are good at looking for opportunities for where capital can flow to, but rarely about the parts of our social and our planetary systems where investment tools aren't that useful. Kate Raworth, who I'm a big fan of, very wisely said that the market is like fire. It can be extremely efficient at doing what it does, but it can also be a challenge to contain. It's helpful to have fire in the kitchen to cook with. You would all over your house everywhere. And it seems really to have been it seems to become increasingly unimaginable to question whether profit-seeking investment should have a seat at every table. But public goods like nature, like forest conservation, flood defences, homes for the elderly, they're unlikely to be properly financed by return-seeking markets. The vast bulk of carbon credits and nature-based so-called solutions are other really important examples of this, I think. So for me, a lot of capital with purpose is really about talking about taking responsibility for where capital is actually useful and staying out of where it isn't.
Great stuff. Thanks, Leah. I love that analogy. Go-san, to you, please, sir.
Yeah, thank you, Jonathan. And usually when we talk about capital or finance in general, we tend to think about like numbers, like ratios, like internal rate of return, like risk premiums and that. And basically, these can be all explainable over the spreadsheet. But when I heard this phrase, capital with purpose, for the first time, I thought it is very powerful and compelling, actually. For example, when we get to make an investment of $1 million, what if we get to support co-producers to pollute the air? Or what if we finance the reforestation to support the livelihood of the indigenous people in the tropical forests, let's say? So it's actually pretty much about the imagination, and it's pretty much about the imagination to create your own narratives, the narratives to save the planet, narratives to create a society which is more inclusive. And this phrase would force you to extend beyond the spreadsheet, to think through those narratives. And I hope that this session today can help every one of you here to create your own narrative for your great purpose. Thanks.
Thank you, Go-san. We'll try our best, but I love that, beyond the spreadsheet. And thank you, everyone. I think what's striking is how those definitions that you described already hint at both the promise and complexity of this topic. But before we dive in, I do want to take a moment to recognize our organization's honorary chairman, Ambassador George Harrow. His thinking has really inspired the spirit of today's session. So I'll start with a short reflection on one of his key ideas, which is public interest capitalism, to set the stage. In his seminal paper, Ambassador Harrow reminds us that capitalism was never meant to serve shareholders alone. He argues that companies are, in essence, public institutions, responsible not just to investors, but to employees, communities, and ultimately the planet that sustains them and us. Profit, he argues, still matters for the spreadsheet question, Go-san, but only as a means to shared prosperity, not as an end in itself. He challenges us to ask what real success looks like: growth on paper, on that spreadsheet, or growth that genuinely improves lives and strengthens societies. And that brings us to the heart of today's discussion. If capital is to serve the public interest, how do we design the mechanisms that can make that real? Now, building on that idea of serving the public good, I think it's impossible for us not to talk about public interest without talking about nature. The devastation we are seeing almost on a weekly basis from climate impacts reminds us that the financial decisions are never just economic. They're social and ecological too. Christina, I'd love to bring you back in here. You've been keeping an eye on the evolving landscape of corporate finance under the Paris Agreement. From your perspective, how do these mechanisms help turn climate commitments into real-world results? And what safeguards do you think we need to make sure they protect both environmental and social integrity?
Thanks, John. Yeah, I think, look, just circling maybe back, taking one quick step back, I think, we often look and talk about climate finance as kind of a fight over who pays how much and, through what types of channels. At every COP, I think probably in a few days, we're going to revisit this topic as well. But we're entering, I think, a world where unfortunately, especially since the beginning of this year, traditional development finance flows are tightening. Budgets are reprioritized, and every basically public dollar has to work harder. And I think specifically in the blending space and more broadly the finance space, leverage is becoming a key word today. So this is why these cooperative financing approaches, particularly under the Paris Agreement, and especially interesting to me lately has been Article 6.2. And this is where I'm starting to get excited. Because implemented right, I think this mechanism does have the potential to lead to real world outcomes. However, it also gives me a lot of anxiety, which I'll circle back to in a minute. But what is specific is, unlike traditional climate finance, which is mostly input based, so capital flows up front and outcomes come later, Article 6.2 is performance or results based, right? Which means countries are paid for verified mitigation outcomes. And it is basically results based climate finance, and that fundamentally shifts incentives. So it rewards delivery, not promises. And maybe just for those that are listening who are not that aware of what Article 6.2 is in terms of the mechanism. So basically, it's the option under the Paris Agreement for countries to transfer emissions reductions between themselves. So they transfer so-called mitigation outcomes, or as they're called, internationally transferred mitigation outcomes, ITMOs. And basically, they need to follow certain rules similar to the carbon markets to obviously avoid double counting. So there need to be corresponding adjustments. There needs to be a lot of transparency around the registries and so on. So those are risks, of course, of implementation. But think of it kind of like a sovereign to sovereign results trading, although the private sector can, of course, participate in various ways, but it's a sovereign to sovereign results trading where climate results or outcomes become a financial asset. So where my excitement meets anxiety is that there are two types of basically mitigation. So the easy or the low-hanging fruit, and the hard ones, the structural ones, the high-hanging fruit. And Article 6.2 opens a real risk of over-transfer, meaning where developing countries sell too much of that low-hanging fruit, of that low-cost abatement potential, and are left with only the expensive mitigation later. And then at the same time, of course, wealthier countries may delay their own transitions. And that obviously, shouldn't be happening. But under our current modus operandi in the financial system, as we discussed, it is a potential risk. So if it becomes a hunt for the cheapest ton, we repeat the zero-sum game logic, right, from the past, and this time with carbon. So I think that when looking at implementation, the key question becomes, does cooperation raise ambition on both sides, or is one relying on negotiation power and the lack of knowledge of the other to basically in the future reduce it? So avoiding this requires sovereign strategies and readiness, right? Especially on the host side, or in many cases, the host countries are the developing countries. So really having that long-term view, costed NDC pathways, and very clear limits on what gets authorized, pricing in the opportunity and cost of corresponding adjustments, ring fencing ITMOs, and proceeds for development, and building generally just capacity. So before, obviously, I stop there, I just want to highlight that there are already success cases because we're very early in implementation. It's very early days, but of course, Singapore, where I'm based, has a whole Article 6 approach, and Switzerland is another country that is very active in these bilateral discussions. And there's an example of Switzerland and Ghana, for example, where carbon revenues have supported clean cooking. They've resulted in community benefits, capacity building, and obviously they've baked in volume limits as part of their agreements. There's also one example that is closer to home between Switzerland and Thailand, where basically there is an e-bus program that Switzerland helped Bangkok integrate. So this is the first fully executed 6.2 deal, actually, where verified mitigation financed this urban electrification. So again, if we get this right, such type of collaborative approaches can help countries avoid debt-heavy climate pathways. But if we get it wrong, we basically compromise potentially developing countries even further, and basically we fail what we put out in the Paris Agreement.
Got it. So excitement yet trepidation at the same time, Christina. I love that. And 6.2, yes, I mean, it's a real hot potato in its way, but your answer touches on something, and I'd love to throw a curveball in at you now around the moral symmetry of capital. Because with 6.2, you have credit for good, and should there be debit for harm? So there's voices such as Sasha Beslik and others argue that the reverse should also be true. If a nation's capital finances fossil fuel expansion overseas, should those emissions not appear on its own balance sheet as well? Bit of a curveball, but I'd love your very quick thoughts around that.
Yeah, I mean, that's a sticky subject. And again, circling back to what I said in the beginning, I think the truth is our financial system was built to operate on the single ledger, right? That basically goes to monetary profit and loss. So we've talked about the triple bottom line consistently in the past as a concept, but I think, you know, what the example that you mentioned by debiting and crediting harm, I think goes beyond that and actually tries to lead to a proper framework in which we do that and in which this harm is properly accounted for. And that's why we do need such a thing as if I can call it a dual ledger, right? One that tracks financial returns, but then another that captures that these social environmental outcomes. And not kind of as a add-on, but really both need to be integrated as part of valuation, as part of risk, and generally as part of accountability. So like you say, we can't only count the trees that we've planted and the solar panels that we finance, we must also count the emissions financed, the ecosystems degraded, and the negative impacts on communities and their livelihoods. So net impact should truly be the bottom line. But again, this asymmetry or this symmetry can be institutionalized through standards, through carbon and nature, accounting and pricing, and also things, you know, through things like impact materiality or double materiality in general. And these are all steps in which this is kind of in a way starting to be systemically implemented. But of course, we need kind of stronger buy-in and again, alignment on the systems level for this to really work properly.
Super, thanks, Christina. Watch this space. Gosan, if I could turn to you regarding Christina's point about the symmetry there. You've worked with blended finance models, I believe, to designed to balance impact with accountability. How do you think these principles might be embedded in the financing structures of the future?
Yeah, thank you. And Jonathan, I think that is very interesting question. And let me ask a quick question for you, actually. So by saying accountability, you mean those which would be ensured through like the governance or like incentives or some sort of the frameworks or anything to tackle how to take responsibility for doing something harm?
Yes, the former rather than the latter, not the ethical considerations around that, but the former, the governance. Okay. Yes,
got it. Yes, it's very interesting, and where obviously the basic mechanism of blended finance is to leverage the concessional resources like grants or like concessional loans, basically to give the incentive to do more investments on particular purpose. For example, through reducing the cost of capital or like providing some risk mitigation, de-risking, credit enhancement and something. So those instruments, like I would say like the financial instruments in general, would not necessarily cut out for doing something to give some sort of like disincentives to do X, Y, or Z. But at the same time, it's very interesting. For example, in the case of the performance-linked instruments, they are pretty much linked to how much results, whether it's good or bad, would be done. And it would be actually linked to the pace of the disbursement of the payout. So it's very interesting. And getting into this incentive part of discussion, I would probably more focus on one, safeguard, environment and social safeguard, but also some physical solution like a carbon tax or environment tax, because basically they are the policy tools to sort of like the penalizing how you can be disincentivized to do some things not that good. So
thank you, Go-san. Expanding on that then, how do we then channel that capital into those financing models that deliver inclusive growth at scale, but without losing sight of that integrity that you just spoke about? So in your view, I mean, which models truly seem to work in practice, and what's potentially holding those others back?
Right. We do have a variety of options of financial models or financial instruments, which have taken the grounds over the past decades. Obviously, as I speak, like this blended finance is one of them. So, for example, when it comes to the de-risking, one of the tools we make is guarantee, like the fast loss guarantee. Basically, it is for us to mitigate the risk of the project primarily at the early stage when the risk is the higher. For example, in the phase of the construction, in building the infrastructure in the greenfield project, and that's one solution. And the second one is, as I briefly touched, the performance linked instruments. So, for example, the World Bank has counted much of those projects to date, which are called P4R, Program for Results. And basically, like the indicators linked to disbursement is, for example, like the numbers of distribution of vaccination, or even like rate of the children who go to school, or like the school attendancy and that sort of things. And those social results indicators are connected to how much you can get the disbursement, like how much you can get the payout from those projects. So that's the second kind of primary option we use. But probably the most well-known financial models would be the mechanism that leverage the capital markets, for example, the green bonds and sustainability bonds. And actually, in this area, we have pretty much prominent innovations, which we have seen over even like the past actually 30 days or anything. For example, last month in October, there was this first of its kind bond, which is called resilience bond. And it was actually issued for the first time by the Tokyo metropolitan government. And the basic purpose is that the part of the proceeds would be to finance, to support local communities in the remote islands to gain its resilience against the natural disasters. And right, actually, like Tokyo, it has lots of skyscrapers, but it also within its jurisdiction has remote islands in the Tokyo metropolitan government. But still, my point is that that instrument is intended to support the social resilience of those remote communities. And another example I can share in terms of innovation is that catastrophe bond, which is so-called cat bond. And it was actually last week in Jamaica that the first trigger was hit. The trigger of the cat bond was hit after the crash of the Hurricane Melissa. And the basic structure of the instrument is that the government would receive the payout once there is this parametric predetermined trigger was hit by the latest disaster situation. And there is in this mechanism, there is a trustee who manage the proceeds from the investors. And in the meantime, investors would receive the premium until those crises take place. For example, the prime, in this case, in Jamaica, the premium has been like 4% to 7% per annum. But basically, that's how it works. So these are actually the major lineups of the financial models, financial instruments we have just started to cultivate in this space.
Thank you, Go. Sounds hugely interesting. If I could just ask a very quick follow-up question on that. So to make these models that you've spoken about scalable, what do you think needs to shift? Is it the policy, the incentives, or the investor's definition of risk and return?
Right. That's a $1 million question, Jonathan. And I would say that there will be no single silver bullet to address all these scalability question. And main reason why is that it's not something we can quickly address in a snap, but it's pretty much the result of collective actions through different set of stakeholders. The problem here is that, it's not more of actually investors' appetites than of difficulty, complexities of structuring, or for example, like the pricing of the instrument. So for example, getting back to this case of resilience bond, we saw the oversubscription by 7 times. So the total amount collected was 300 million euro, but the entire bidding was over actually 2 billion euro. So there is this humongous amount of demands to these kind of instruments, but at the same time, it is very difficult to structure. And for example, in the case of the blended finance, we often face this problem of the bankability of the project. And especially compared to such project as the renewable energy projects, it is very difficult to predict the revenue stream of social project or like climate resilience project. And what makes the thing more complicated actually is the risk allocation is constantly the trouble to develop those projects actually. So for example, let's consider about the project to build a bridge to sustain the livelihood of the people in the remote communities, let's say. It's very difficult, and what sort of risks should be taken by who, like the governments or the investors, and those negotiations are constantly very tricky and very political, and it's very, very structural. So given those nature of the issues, again, this goes back to my point that the single bullet point would be difficult. But at the same time, what we can, out of all these experience, what I can share is those instruments would need to be linked to the broader strategy of the government. And when we get to engage some innovation solution, people tend to showcase as sort of like the one-off or spontaneous initiative. And those are good from the headlines perspective for the press, let's say. But when it comes to this situation, like compelling situation that we need to mainstream, right? We need to scale, we need to replicate those instruments, which are not necessarily super easy. We need a certain degree of changing behavior or like the strong commitment. So what is very important and what is very effective based on our experience is that incorporating those instruments to the broader policy context, like the sector strategies or like a country platform or even like a NDC, LTC, long-term strategy, or like some instruments like the National Adaptation Plan, NAP. And there are some efficacies. One is about the, it would allow the stakeholders to showcase their firm commitment, like the very clear commitment to the public. And the second efficacy is give some transparency and predictability for the outside stakeholders, obviously the private investors. And the last one is much more about the, so for example, I raised this carbon tax thing in the previous exchange, but how to position these policy tools in the larger policy package so that you can strategically deploy that financial instruments to maximize the impact. So these are some kind of approach I would want to share with you to maximize the impact and pursue for the scalability of the instrument. Thanks.
You go, Sam. We'll keep looking for that silver bullet. Lily, I'd love to bring you in here if I may, and we're doing pretty good on time, guys. So feel free, to answer as fully as you wish. But Go-san mentioned the tension between complexity and scalability. From your vantage point, Lily, as someone who works with the asset owners, how do you think investors can simplify without diluting that integrity?
Thanks for the question. Yeah, Jonathan, there's so much distraction, there's so much clutter, and from my perspective, it's really critical that we focus on actual flows of capital. As you kind of alluded to, my work is in a slightly different area to Christina and Gorsan's, in that I work with institutional investors, so pension funds, sovereign wealth funds, and endowments and the like, although of course in a broader policy context. I suppose for this question, I would come back to there's an amazing paper by Urban and Bokchik, 2019 paper, I think, that talks about how so much of the challenge that sustainable finance has faced has been that instead of tackling the problem at the source, so promoting the issuance of new debt or equity finance that meets sustainable development goals, really the sustainability transition in finance has consisted of a taxonomic exercise that aims at labeling old finance. So as I think we all have accepted gradually that labeling doesn't necessarily trigger actual reallocations of capital, and it can really risk serving as a smokescreen for inactivity. But nonetheless, it is where we continue to spend the vast bulk of our time and attention in policy spheres and within my area of work amongst institutional investors. And if you put that, I suppose, against the really practical reality, I'm stating the obvious for everyone, I'm sure, but fossil fuel combustion accounts for about 75% of human-caused emissions, 90% of carbon dioxide. We know where the problems are, and investors can simplify while strengthening their integrity in terms of their activities by focusing on those capital flows. So it's lovely that we're doing this today, because it also marks the day that the global oil and gas exit list for 2025 has just been published, a really phenomenal piece of research work and a data source that's used by hundreds of financial institutions globally, including the work that I do. And that list is kind of called GOGEL, I suppose, by those who use it, the Global Oil and Gas Exit List. It shows us which companies are continuing to expand, for example, their fossil fuel related infrastructure, so new gas-fired power plants, new pipelines, new LNG terminals and the like, in contradiction to the scientific consensus on what's necessary to keep us in safe and in livable bounds. So I think really in my work with asset owners, to kind of loop back to your question, simplifying is really about that focus on flows, and it's about that focus on flows where it really matters. So keeping the attention on the parts of an investment portfolio, but also the areas of opportunity from an investment perspective where institutional investors can contribute the most.
Thank you, Lily. I love that phrase, smokescreen for inactivity. I'm going to steal that one. If I could follow up here, though, with a further question for you, how can those asset owners embed that purpose into their mandates in a way that does shift those capital flows? So not just incrementally, but structurally towards long-term social and planetary well-being, in your opinion?
Yeah, great question. As a research centre in Cambridge, we work very closely with actors that describe themselves as universal owners. So they're asset owners such as pension funds, sovereign wealth funds and the like, who really understand that due to their size, due to their diversification, they have an interest in the long-term health of the financial system as a whole, and that this interest requires them to directly mitigate systemic risks. So this looks quite different, I think, to what people often think about institutional investors, with a kind of ethical or a political purpose, where those actors would be focused on, for example, ensuring they can pay your pension in a livable planet when you retire. And that really requires them to think about systemic risks like climate change or like inequality from a much more long-term and fundamentally systemic perspective. And now, if I were to ask, what does that actually mean in practice? Is that a load of nice words, or is that a tangible change in investment strategy and approach. There's a fab study by IEFA, the Institute for Energy Economics and Financial Analysis, and they looked at NBIM, the Norwegian sovereign wealth / oil fund. They looked at its holdings in just 5 mega polluters, so the kind of 5 of the most carbon intensive companies that fund holds, and discovered that those companies, just 5 companies in this huge global portfolio, right, had already reduced the value of that huge portfolio by 5.6 billion USD each year. So it's a massive drag on the returns of the broader portfolio. And IEFA described that, I think, quite accurately, but it's a painful thing to say, as self-sabotage on the part of the asset owner. Essentially, those companies that they're holding are stealing from the pockets of the other companies through the externalities that they're creating. So I suppose with that said, to kind of come to your question, changing mandates as an asset owner might sound simple. You choose who your service providers are. You could say what they determine what you want them to do. But your question is really an excellent one, because there is often a very big disconnect between what asset owners want and what they actually incentivize their service providers to deliver. A big part of this is structural. So a pension fund is generally motivated to make decadal decisions. They might struggle to, because we are short-term human beings. But for their savers and in relation to systemic risk, that is the obligation that they have. That should be what they're trying to do. But they're obliging their asset managers to report quarterly at most. Often they're keeping an even closer eye, and they're assessing them on those timeframes and firing them on those timeframes. So incentives are often very understandably quite misaligned between not-for-profit asset owners, for-profit service providers, with those different timelines and very different communication there. Or take what I said earlier about sustainable finance opportunities in the round and the focus on taxonomizing existing stocks as opposed to kind of driving change through new funds with old money instead of addressing those new flows. And I guess to give you a kind of really crisp example, which is the project that I lead on within the university, 5 years ago, when Cambridge itself looked around for a suitable investment grade corporate bond fund that met its climate requirements, nothing off the shelf was available. There was nothing in the market that could do what we wanted. However, about 90% of new money going into oil and gas comes from bond markets and from banks. So exactly the area that we wanted to have a mandate for. There was nothing in the market that could meet that need. And so we were kind of tasked as a team of researchers and academics to do that research, to do a feasibility study. We were really lucky, incredibly lucky to have market and technical expertise from much larger universal owners. So Publica, the largest pension fund in Switzerland, USS in the UK, CalSTRS, the 3rd largest fund in the States, and the United Nations Joint Staff Pension Fund has been an incredibly important supporter to this project and a co-investor against the ultimate index in the future. And we developed a framework that really aims to give asset owners a tangible blueprint to embed their purpose into their mandates with fund managers. So the project focused on catalysing the development really of a practical alternative, which will be the first global bond index to address fossil fuel expansion. And Bloomberg, the index provider, will be launching that soon. But I mean, hopefully that gives you a kind of tangible example of the challenge. And what it's really taken is actors who don't have that short-term and commercial focus to be able to step out of the kind of everyday business as usual approach of innovation within financial markets, to be able to do something that really focuses on creating a kind of intervention in existing infrastructure that serves the commons. But that's sadly quite unusual, because most actors in the space don't kind of come at this from an evidence-based or academic approach, don't have that that asset owner backing. And honestly, most service providers won't take the time to build something with the level of complexity of what we've been putting together. So I guess all of those pieces feed into an answer to your question.
Excellent. No, you're painting a fantastic picture there, and we all applaud your efforts in this space. I mean, if I could continue with you, what then sort of practical levers from stewardship to incentive reform do you think might align the market systems to become inclusive and sustainable?
Yeah, I suppose in a way I've spoken about one in that this investment grade corporate bond project attempts really to be a kind of, I guess the research that we've done tries to create a systems demonstrator, a sort of blueprint for what might be possible, and then the index providers obviously trying to build that in the real world. But maybe if I build off that and use the same case study but focus on the stewardship side, just because you mentioned that word and it's such an important one. But firstly, before I dive into the case study, it's actually not that surprising that, sadly, that stewardship has failed to really achieve measurable reductions in systemic risk for investors, because the asks that we are giving are generally the wrong ones. There's very limited academic evidence of any correlation between disclosure and improved corporate environmental performance. In fact, what we know is the opposite. There's quite a comprehensive meta-study that concluded that disclosure is not indicative of performance, and that really supports the kind of assertion that poor environmental performers, so high polluting companies in other words, have a very high motivation to increase their level of disclosure, much higher than strong performers. So you essentially see high polluting companies saying more in order to do less. And despite this, most of this sector, most of the space continues to focus on encouraging corporate disclosure within their stewardship. Every conversation I have with an asset manager, I ask them, what stewardship activities are you doing? Every example they give me is about hearing more from the company about what they're disclosing. It's not actually about the corporate activities. So it's not that surprising that the activities aren't changing. And it's deceptive. You know, our language has shifted gradually from asking for carbon emissions reporting to asking for transition planning. But ultimately, these are all pieces of disclosure. They're not actual changes in current corporate practice. So to kind of loop back to the bond index project, what we focused on with the research was really attempting to identify what we describe as a set of ungameable metrics. I feel like this is kind of millennial language, gameability, but essentially something that you can't fix, you can't manipulate in any way. So really things like whether a company is building new LNG terminals or new gas-fired power plants, fossil fuel infrastructure, which presents a clear systemic risk, which brings in decades of lock-in, for universal owners and for us societally and on a planetary basis, and which literally can be seen from space. So it can be very readily verified, right? And from a stewardship perspective, that makes the state of play really clear for companies. If they cease expansionism and if they phase down in a credible way, then they meet the index methodology's criteria and they can be admitted into the index. And the index provider there is serving as a kind of neutral arbiter. They're just implementing the methodology. It's not their job to say yes or no. They just implement the rules, essentially. Investors also have a much clearer rule than they otherwise would in terms of stewardship, because they're just communicating an opportunity to access the capital that will be presented by a change in corporate behavior. So they can say to the company, look, if you stop building this pipeline, you'll get into this index that has the potential to reduce your cost of capital for other activities. It also reduces my systemic risk. So I would much rather you do that and much rather be able to invest in you. So it kind of gives a really clear carrot and stick that's attached to the stewardship that's much crisper than what we've seen to date in terms of bondholder engagement. And I guess furthermore, it really takes investors out of the kind of thicket that we're otherwise stuck in of differently estimated emission scores, implied temperature rises, transition plans and the like, none of which are really necessarily connected to the company's own actions or to planetary impact. So we hope that it gives companies a much clearer set of incentives to follow what they get from investors in terms of that stewardship engagement as well.
Thank you, Lily. I love that, you know, the circularity of that new way you've described, and against the infamous spin. It's always
That's our hope. I mean, really, it's about creating a positive spiral and being able to have a much more productive dialogue with companies.
Indeed, indeed. Thank you. Christina, I want to circle back to you at this point for your perspective. How could those frameworks, such as the National Sustainable Finance Roadmaps or transition taxonomies, really help what Lily's described?
Yeah, and I think, Lily, thanks, John. And I think Lily already mentioned a little bit of this, but I mean, they can be powerful tools because they turn this purpose that we're talking about into architecture, right? So they give asset owners that clarity on what credible transition looks like, and a strong national roadmap links those climate ambitions, or is meant to link those climate ambitions to industrial policy, to new skills, to social outcomes, basically. And then a taxonomy, especially one with transition categories, which we know very well here in ASEAN, with those transition categories and minimal social safeguards, they create basically those investable pathways in the hard-to-abate sectors in emerging markets, which, you know, in any other case would exclude them. And of course, this matters because that capital with purpose cannot only go to green, right? But this region and the developing world is much more different and a different stage of development than others. So we need finance also, and the classification of finance on how to basically go down that journey. But something I want to also circle back to, as Lily mentioned, you know, of course, these taxonomies and basically finance roadmaps are very important because, as I mentioned, it kind of gives that architecture to purpose. But products are another thing where we need, I guess, also stronger safeguards in a way. And a really interesting example that I came across this year is actually a company headquartered in Singapore, and they issue the so-called orange bonds. And what's impressive there is that they have these bond principles like any other kind of thematic or labeled instrument, but they have, as part of the requirements, a last mile verification, where actually the recipients of the proceeds, which are usually your female owned, so orange, sorry, just to go backtrack, orange, why? Because SDG 5, gender equality, is orange, and these are basically gender plus social. They're aligned with basically the greens and the social and the gender bonds. But that last mile verification is so important because then that gives you the ability to track whether those proceeds are actually reaching those businesses on the ground. And I can imagine that uptake, because of the robustness of this, is still, you know, something that the market can improve on. But again, just going down from kind of the infrastructure of the classifications down to the products as well, there is area for improvement. And we can actually also build better investor confidence through certain small levers.
Yes, Christina. Orange bonds. I think they have the same wallpaper as we do. I really like that. I'm just checking my clock here, guys, and I think we do have time for one last question. I mean, we've heard some fantastic ideas, strong ideas on cooperation, execution, and governments. So I'd like to open this up a little bit to you guys, Christina, Lily, Gosan. Would anyone like to build on each other's points or ask another question or reflection to the panel?
I'm happy to dive in
Please,
with one,
please,
if I
Lily.
may. Yeah, I suppose maybe just to take us back to the theme of capital with purpose. If capital is truly to serve systemic change, I'd love to hear about one behavior, one mindset shift that you think leaders themselves need to make.
Oh, super question. Christina, you've just spoken, so I'll go over to Gosan, if I may, and then circle back to you. And then I'd also love your answer to that, your own question, Lily, afterwards, if you could. Gosan, please.
Yeah, thank you. Yeah, that's a very interesting question. And you mentioned about the changing behavior. And I think that has a different kind of dimensions we can discuss. Obviously, like every single one of us more or less like faces this kind of institutional arrangement, like some occasionally facing some, how do I say, like barriers and like the silos across departments and anything. And yeah, you asked about the mindset, and that real eventually comes down to, again, like the imagination. Probably I might have raised this at the beginning, but how your every single decision making through your business would affect the greater purpose. I think that's a very important aspect we should be mindful of. And also from a little bit different angle, I would also kind of re-raise about this efficacy of like the strategic approach, like this collective kind of efforts across different stakeholders, because obviously like every single different stakeholder has different minds, different set of incentives, right? So how you can collect the actions and incorporating some strategies should be very, very effective methodology to perform those kind of things as well.
Thank you, Go-san. Christina.
I had some time to think, so now I have two, but I promise it also builds on Go-san's answer a little bit. So I think that the need in mindset shift that I see is going from, similar to what Go-san said, going from that kind of silo type of thinking, or more kind of the leadership being the center of gravity in whatever area or subject matter they're working on, and mostly thinking on that systems level. And what I would add on here is going really from that quarterly type of thinking to generational thinking, right? Going back to that pain point that we have about short-termism. And again, systems level capital, really, it requires the time horizon that's aligned with the lifespan of a system, or at least changing a system, not a reporting cycle or not a bonus cycle, right? So I think for me, that's the most important part, breaking the silos and change in mindset where they realize they are part of a system, and shifting the time frame and going from that quarterly annual type of thinking to really generational thinking.
Yeah,
thanks, Christina. Lily, the boomerang comes back to you. Love to hear your thoughts.
It does indeed, and I feel like Go-san and Christina have spoken to points that I very much inspired the context about scale and about time. And I think time, I mean, obviously I mentioned it before as well, but this concept, I think about a lot of cathedral thinking, which Roman Tsanovich has popularized. Obviously it's a much older idea, but of planning and undertaking projects that have time horizons that stretch well beyond a lifetime. I think that kind of thing is really what you were speaking to, Christina. So I'll say something else instead, having dropped that in, which I think maybe is about a willingness to be unpopular. I think this is a space culturally just filled with a lot of people who want to be nice and want to be liked. That's the case for many industries in many areas, but it isn't the responsibility of somebody running a pension fund to be liked. It's the responsibility to make sure that they can pay the retirement of their savers in 50 years plus. And I think that has been really interesting for me to see in a obviously very challenging context that we're currently all operating in. Seeing the number of large global asset owners who are starting to step up and speak in a way that they haven't before, really, about the scale of their responsibilities and the state of their dissatisfaction with often what is being delivered by their service providers as well. So seeing, often small, relatively ad hoc, what's often described as kind of critical yeast groups, so not critical mass, but critical yeast, the sort of initial spark of a possibility that's being posed by some of these universal owners, so large global asset owners that have enough independence from current political trends, from current geopolitical trends, to be able to say, look, our priorities here are different to the way that perhaps things more broadly might be moving. We're thinking about this in terms of systemic climate risk, and we want our providers to be doing the same for us, and we will change our providers if they don't. And that's been really striking to see, because I think in somewhat sunnier political times in that context, we didn't see that. So that willingness to step out and stand up, I think, has been really, really striking to notice within the asset owner community.
Here. Thanks, Lily. Fantastic. Well, today, guys, I mean, we've explored mechanisms, ethics, systems, and I'm looking at the time, we're on the home straight. So now, for the last few minutes, and I'll give you 60 seconds each on this one, guys, I'd like you all to look and gaze into that crystal ball. If we were to look ahead 5 years, I mean, we should be looking further, but let's go for 5 years from now. What signal, metric, mindset, shift, story, whatever, would show you that we've truly mobilized capital with purpose? Who wants to take this one first? Christina, I'll start with you, and then Lily, and then Go-san, if I may.
Sure. I'm very hopeful that within 5 years, this utopian kind of positive ideal in my head will come true. So here's hoping. I mean, for me, this means that success won't be measured only in capital deployed, but rather really in quality cooperation and I think in futures protected, and I think futures here again is the key word, because we need to think more about future generations. So when fewer families are displaced or forced to migrate, when countries basically keep their future mitigation potential and their competitive advantage. And I generally think, or genuinely rather think, that climate and nature finance, as well as kind of the cooperation now at a global level that we face, are ultimately the test of our humanity. Because, you know, if we continue as we currently are with this kind of zero-sum approach globally and thinking, I don't think that, you know, we can run basically very much longer. So we need to think kind of collectively as a global community. Climate change and nature loss and social development challenges are global issues, and I feel that we need to somehow forget all of this competition, at least on some level, and basically look at how we work together. And for me, if we're able to do that, that's what kind of the future looks like in 5 years.
Thanks, Christina. Lily, if I may.
Thank you, Jonathan. Well, Krista Tippett talks about hope as a muscle, and I think that's really helpful here. It's not something you just have or you don't. It's something you build. It's a verb. It's something very active. And I think when I think about being 5 years in the future and what would be different, what narrative or what story, I think it would be seen as very strange and potentially quite foolhardy to develop financial products that provide new capital to fossil fuel expansion, given what we've known for such a long time now about the lock-in that, decadal lock-in that comes from building new infrastructure like gas-fired power plants and the like. So I think that would be just seen as something that we did many, many years ago, and we can't quite understand that we continue to do in 2025.
Fully agreed. Go-san, please.
Thank you. I would like to add a little bit different angle, which is about the harnessing the potential of technology over the next 5 years. And on the daily basis, we are experiencing and feeling, how our daily business would be impacted by ChatGPT, like generative AI and other set of technology. And going forward over the 5 years, the make or break should be pretty much dependent on how much you can leverage those impacts provided by technology. And allow me just to briefly introduce what I'm doing right now with the Armstrong Foundation. We are actually a global philanthropy to leverage those technologies to pursue for the social inclusion. We provide the digital cash flow, the digital cash transfers to those remote communities where internet connection is not secured. And what I have learned, like this experience with the foundation, has shown that when capital meets the right technology, it can turn what has not been possible to the daily kind of daily practice. So it's obviously like how much you can deploy the capital, but also how mostly we leverage the potentiality of the capital should be also impacted by the technology as well. So I would like to have this as my concluding comment.
Thank you, Go-san. Anyone with technologies out there that needs funding, Go-san's details. Please do get in touch. So, guys, we're almost on the hour, but I want to thank everyone. I really enjoyed this session. I'll try and sum up very quickly because of what we've heard today. I think it's that, purposeful capital isn't just a slogan. It's about design and the systems, ultimately, and the incentives and the choices that shape where the money flows and what it achieves. Christina, you reminded us that the purpose means cooperation and integrity. Finance that empowers rather than extracts, and mechanisms that protect both people and planet. Go-san, you showed us about imagination and how structure can coexist, and that scalable finance needs not just spreadsheets, but those stories. and models like resilience and catastrophe bonds that turn narrative into tangible impact. And Lily, you've kept us grounded in the responsibility of those who hold the capital, reminding us that systemic change begins when asset owners use their power to shape the markets for the longer term, not just the next quarter. As a collective, I think we've all shown that purposeful capital is less about the volume of money and more about the value that guides it. And ultimately, for all its allure and mystique, capital remains a commodity, a tool for us to use. Let us spend it wisely, guys. Esteemed panel, thank you so much again for being with us today. And to everybody watching,